we're looking for what are other parts of the economy that we can invest in that maybe have more upside long term. If we look at, how has healthcare done the last 10 years, and AI is the second leg of the stool. Well, what does it mean for these businesses? Good afternoon, Patrick Dwyer and Greg Pool here at Aligned, and we're here today to talk about healthcare.
Yeah, so healthcare, we're moving to modestly overweighting healthcare in our equity portfolios. And so this is a change. And as you know, we don't make changes too much. We think about things a lot. We talk about things a lot, but we don't do many things. So this is something we're doing. We think the timing is right, and we want to talk about healthcare. Let's just get a little bit into the space. Healthcare is not one thing. It generally encompasses a range of business models that includes pharma, biotech, medical devices, healthcare services and managed care, and healthcare tools and tech enablement. These are very different industries, different business models, some innovation, some operational, and some administrative. But we see opportunity broadly across this sector. Pat, why don't you talk about the why?
Yeah, why is because the returns haven't been very good, and the returns of your technology stocks have been incredible. And technology is now 35% of our direct index, and it's getting up there. And so we're looking for what are other parts of the economy that we can invest in that maybe have more upside long term, and also are a little bit defensive, like in case everything doesn't work out perfectly. And so if we look at, how has healthcare done the last 10 years, it hasn't done very well. So biotech has a 4% compound annual return. Healthcare services, 8%, broad healthcare, about 9.5%. Medical devices is by far the best at 13%, which is terrific, until you compare it to tech, which did 23%. That's a dramatic difference. Now, we're not saying that healthcare is going to have the return of tech, but it could certainly have a bigger return. There's been past decades where healthcare had incredible returns, and we think we might be upon one of those time periods. So our thesis is that things are going to change. In the past decade, we saw technology had growth plus multiple expansion, and healthcare had earnings growth and multiple compression. So what's going to change? I don't know, but let's look at what the valuations are.
We're starting from a much lower starting point, right? So if we look at valuation snapshots today, tech 26 times. Now that's great growth, great cash flows. We love tech also, but that compares to, healthcare broadly at 17 times, pharma 16 times, and healthcare services at 10 times. The market still pays, healthy multiples for healthcare, tools and enablement, but anything that's policy exposed is trading at a much lower level. And I think we have to also look at the margins and the quality of these businesses. We think broadly speaking, healthcare is better than many people give it credit for. If you look overall, the margins for the industry are attractive, but it's very bifurcated. Biotech, you have 25%. That's even better than tech margins at 21. Pharma is still at 21, and that might come down with some pricing issues, but it's going to be high. And then you got medical devices that are somewhat under 10, and it's really dragged down at the industry level by healthcare services, which are at a paltry 4%.
Yeah. And so I think it's really important to understand, where you make a lot of money over time is investing in the space when it's cheap. I mean, it's really that simple. If you're looking at your portfolios and thinking, wow, my international has done really well the last 3 years, that's because we invested in Asia when it was cheap, right? And Asia has its undemanding valuations to this day. We feel that healthcare is the big sector of the U.S. economy that no one's talking about. And, let's look at free cash flow and look at that a little bit. So tech has very high free cash flow, but it's super competitive, right? New products can be built easier and easier. So there's more risk there. And it's very CapEx sensitive. Pharma has really great free cash flow as well. But remember, they have patents and you have a patent cliff, right? So you make a drug and then there's a beginning and an end to how long you're going to make money with that drug. So it's a little bit different. Devices have really consistent cash flow generation, a lot like really tech. And then services have very low margin. It's a very low margin business, but you got really high operating leverage. So we don't need like a perfect 10-year free cash flow chart to understand this. Devices and pharma get real cash, services don't yet. And that's where the efficiency gains may matter the most in the places that haven't had them before. Let's talk about drug pricing, your favorite subject, being a Boston guy. Tell me about drug pricing.
Yeah, so Look, I think, like Pat said, we like to invest when valuations and expectations are low, but where we actually have a more positive long-term view of things. And, pricing was something that was an overhang in this industry for years. I'd say it got so bad that we heard the term uninvestable used, and we haven't really heard that since people said that about China a couple of years ago, which is when we were actually adding to China as well. But we really feel the pricing reform, it's been somewhat addressed. It's not solved, but it went from threat to framework. The volatility tied to pricing has diminished. And as a result, management confidence and investor confidence has improved. Once you can model something, it stops being existential. And so, that has improved the sentiment. The sentiment had been really negative, but the policy clarity has improved that. JP Morgan, heading into JP Morgan, the tone has been more constructive. You've seen more M&A, and M&A expectations have improved, and biotech funding has stabilized. So, we see a lot of things that are leading to an improvement from a very low sentiment level.
And of course, our favorite subject and everyone's favorite subject is AI. And AI is the second leg of the stool. But frankly, without the policy shift that just happened, the AI, we all market knew about the AI. So that's kind of out there. Well, what does it mean for these businesses? Like the administrative cost savings, and these are just estimates that people have put out, are like somewhere between 13 and 25%. The medical cost savings, a little bit less, between 5 and 11%. But I mean, it's impossible to guess how many breakthroughs we're going to have in medicine. But my guess is most of the breakthroughs are going to reduce costs, right? Because you're going to improve outcomes, which reduces costs. So it's very exciting to think about it from that perspective, with a 10-year time horizon, right? This isn't going to happen in a quarter. It's going to happen over a decade. But if you are slightly overweight this really big sector, which is very defensive in nature and a lot cheaper, if tech has a setback, being more exposed to healthcare could be smart, could be really smart. So we're very bullish. Now, how do we do this? Is very simple. Within our VISE portfolios, they're totally customizable with our technology. We can just literally go to that portfolio and just increase the overweighting of the indexes by 2% in healthcare. That's all we need to do. Very simple, very easy, with a minimal tax impact on client portfolios.
So that, I think, encapsulates our theory on healthcare, and why now. We think the stars have lined up for it to make sense for us to go overweight. Not many people are talking about it. There's a lot of attractive qualities about the industry. And we actually think AI can help some of the lower margin pieces of the industry really improve on a percentage basis from a very low level to a less low level.
So 2% disciplined overweight to healthcare. It's not a macro bet. It's not replacing technology. It's just an incremental rebalance towards quality in the healthcare space. Thank you very much.